Hello, and module two of personal finance and money management. In this module, we will look at practical skills, practical tools that will enable us to manage money wisely, make informed financial decisions, and develop essential habits that support financial freedom. Every topic that we'll do in this module is here to help you to build real life situations that will face as an adult. We'll cover topics from budgeting, banking, all the way up to credit and taxes. In this module has got 5 essential lessons. This module has got 5 essential lessons or sub modules, and these are budgeting and goal setting, banking, basics of banking, understanding credit, savings and investments, taxes, insurance, as well as financial planning. Each section that you shall do in this topic introduces more the core concepts of money skills that you can apply right away after we have looked at this topic. So these are the modules that we shall look at. We've already mentioned them: budgeting and financial goal setting, banking basics, understanding credit, savings and investing, taxes, insurance, and financial planning. By the end of this module, you should be able to create and manage budget effectively, set financial goals, use banking system responsibly, and maintain good credit habits. These skills that we shall learn here, they'll form the foundation of long-term financial stability. The details that we will cover, they'll be deeper. We might go beyond these 4 learning objectives, but basically these ones are the 4 main that we shall be looking at. So let's start by looking at why personal finance actually matters. Money affects every facet, every aspect of our lives. And this ranges from the time that we start going to school, all the way from education to career choices to housing to retirement. And so having the knowledge about finance, which is basically financial literacy, will give us confidence and independence, while at the same time help us know good money habits and poor money habits, so that we can be able to avoid the poor or bad money habits. Remember this, that you can't control the economy, but you can always control how you respond towards the economy. So that is why personal finance matters. Let's start by looking at lesson 1, where we are looking at budgeting and goal setting. Now, we start this topic by looking at a budget. And it's essential for us to understand, like, what is a budget. This is a term that we have come across it, and a budget is basically a plan that tracks income, tracks your income, tracks your spending, tracks your saving. Sometimes also tracks your investing, so that you know exactly where your money is going, where your money is coming from, and where your money is going at the same time. So what a budget does is that it gives you total control, and it prevents you from overspending, and this ensures that you stay on track towards your financial goals. Think of a budget like a GPS, a compass that is always keeping you in a particular direction, so that you do not get lost. So the budget will give you a control over your finances to prevent you from overspending the money that you have. It ensures consistent saving, and it helps you achieve your financial goals faster. Those are the 5 reasons. And also, just to add another one, it improves your decision making and makes you aware of the financial decisions that you make. What are some of the elements of a good budget? Now that we've talked about the purpose of a budget. What are the elements of a good budget? So, a basic essential budget has got five key parts or five key elements. And the first one is your income. Where is your money coming from? What extra sources of revenue do you have? So these ones are listed on your budget. So a good budget has got your income sources, your fixed expenses, your variable expenses. Fixed are those that don't, obviously, they don't vary, like your rent, your if you pay school fees a particular amount. Then variable expenses are those that will vary on a monthly basis depending on what you are purchasing. A budget will also have savings and investments, and as well as a portion for us to do adjustments. So you are advised to review your budget on a monthly basis. A budget is not cast from stone, so you are advised to review your budget on a monthly basis and constantly make adjustments where need be, because budgeting is not a one-time task, but it's always an ongoing process, an ongoing habit that enables us to track our money at any given point in time. One of there are several budgeting frameworks that we use, but one of the key budgeting framework is what we call the 50-30-20% rule. And this is a simple way or a simple budgeting plan or framework that enables us to organize our funds. So 50-30-20 basically implies that you're going to allocate 50% of the income money that comes in for your needs, 30% for your wants, and 20% for savings or debt payments. If your income rises, you avoid lifestyle inflation, but instead grow your savings. Now, this is not the only budgeting framework that we have. Depending with your needs, depending with your financial goals and aspiration, there are others. Like there's others, for example, 50-30-10-10 or 50-20-20-10. So this, you are not tied to using the 50-20-30% rule only, because there are various budgeting frameworks that you can use to save your money and be in a better position financially. So attempt other budgeting methods, they're available, but this one is the one that is commonly used, and you can use it for your budgeting blueprint when you start your budgeting. After we've looked at budgeting, it's essential that we know what is financial goal setting. Many a times when you start the process of budgeting, you'll be required to set your financial goals. Look at this as the direction that you want to take toward something. Possibly you want to save money for school fees. You want to save money to start a business. You want to save money for a future project. That becomes your goal. So financial goals will give your money a purpose and will give your money a sense of direction. And this will turn vague dreams into clear action plans. So this will help you to shift your mindset from a mindset that earns to spend to a mindset that saves and invests. So goals can be short term. We have got three categories of goals. Goals can be short term, they can be medium term, or they can be long term, depending with what are your objectives are, what are you basically working on. So there are those, and short term is 1 year or less, medium term is 2 to 5 years, but then when it comes to long term, we have got over 5 years. So it's essential for you to know and understand what your goals are before you set your financial goals. Now, after we've looked at in the process of looking at financial goals, we are always advised to set SMART goals. And SMART goals framework is a framework that is used to have achievable goals, and it basically stands for specific, measurable, attainable, relevant, and timely goals. The SMART goal setting framework will enable you to have a realistic saving plan or a realistic plan for your money. A good example, I will save $2,000 for a laptop within a period of 6 months or within a period of 7 months, instead of just saying vaguely that I want to save more money. So the more specific you become, the more realistic and the more easy and achievable it is for you to achieve your financial goals. So it's important that you set specific goals, measurable goals, attainable goals, relevant goals, and time bound. Your goals have to be time bound so that you are working in a particular time span and you don't have just the whole 2 3 years to work on a particular financial goals. After looking at financial goal setting, let's jump in and look at banking. Banks. The word banks is not a new word to us. So banks are essential partners in managing your money. They serve us with a range of services. They provide a safe place for us to save cash, to store cash, to access credit, to invest money, and to help us keep a record of the transactions that we carry on each and every day. So banks will help you to build a financial history, make payments on a daily, easily on a daily, weekly, or monthly uh, terms, periods, and receive financial advice. There are largely two categories of bank accounts. An account is where your money is stored. So the first one is a checking account, and this one is used for everyday spending and payment. Another one is a savings account. This is used to store your money and earn interest over time. Many people will always have more than one account, but there are still some who only have one account and is still okay. So spending, if you have two, obviously one is for spending and another one is for growing your money and saving your money over a given period of time. Now that you've looked at banking, it's important for us to understand a concept about banking, like how do banks function, how do they operate, where do they get their money from, how do they run as businesses. So when you deposit money, the bank lends some of that money to borrowers, and you will earn interest for saving. But then the bank will give its money, will lend its money. And normally the banks will lend the money that you've given them at a higher interest to a borrower as compared to the interest that they pay you. For example, a bank can pay you an interest of 4 5 6%. On the same amount, the bank will loan out that money to another corporation, to another individual, or to the government, and lend it at an interest of maybe 10% or even 20%. The difference in the borrowing and lending interest is how the banks makes money. It's paramount for you to have this information that a bank protects your money up to 250,000 per account. When choosing a bank, it's paramount and important for you to consider factors such as accessibility, such as management fees, such as customer service. There might be other factors. So these ones matter more than the small interest differences that will come across when selecting or when choosing a bank for you to use. With technology evolving, there are different banking tools that are emerging. And so in today's system times, banking is majorly a digital affair. We have got online applications, we have got debit cards, we have got automatic payments, and this enable us to transact, this enable us to carry out our transactions um, much easier than it was initially. So when it comes to, because of the digital banking, you are always advised to be responsible and cautious when you are using passwords. Avoid public Wi-Fi, because when you use it, your money is exposed to other people who you don't have access to, and people might have bad intentions towards your money. They might hack your account and just transfer your money. So it's important that you are cautious when you're using passwords over public Wi-Fi. So that, and this is basically done to protect you and your money. Let's look at credit. Credit allows you to borrow money now, do a project, and pay later. But it's a tool that must be used wisely, because loans and credit cards can build your financial future, or at the same time they can destroy it, depending on how you manage them. Lenders, banks, and other financial institutions will always use your credit score to decide whether you are credit worthy or not, to decide whether they can give you money, whatever amount of money that you want or not. At the same time, they will also use these values, the credit score, to determine how much money you are um, eligible to get. So the credit score it it is composed of numbers. So it's basically based on factors such as your payment history, your credit utilization over a certain period of time, the length of credit history, new credit, and credit mix. It contains all of those factors. So it has got the weight, and then it has got an example. It's important for you to understand at what point should you exceed a certain credit score, and at what point are you safe to be given credit, and at what point are you not eligible to get this credit. Let's look at investment now that we have looked at credit. Let's look at investment. And saving money helps you to build a financial safety. Saving money, similarly, helps you to both saving and investing. Saving is for a short period of time, while investing is for a long period of time. All these will enable you to save, will enable you to build a financial muscle, build a financial buffer, so that come tomorrow, the day that you are not working, or days after you've worked and you've retired, you can still access uh, finances to take care of your daily or weekly or monthly needs. So, in saving allows you to keep money for short-term security, while investing allows you to keep money for long-term, over long period of time. The earlier you start saving and investing your money, the better, because of the compound interest. Compound interest implies that you earning interest on your principal and on your interest. So you'll earn money on the principal amount, and at the same time you earn money on the interest that you've earned. These are the common investment options. When you talk about investment, briefly, investment is, I like referring to it as sending your money on a mission, so that you send your money to go and bring some more money. So the common investment options that we have right now are stocks, bonds, mutual funds and ETFs, real estate, and retirement accounts. Each of these investment option has got its own risk, rewards, which are the return level. So it's always important for us, when thinking about investment, to diversify our investment assets or investment classes, so that should one asset uh, dip, we are still covered by other assets that we have invested in. So all of these Uh, and just going through them briefly. Stocks involves ownership in companies. When you buy shares or when you buy stock for a particular company, you become a partial owner of that company. When those shares, when their prices performs well, it means that the particular investment that you put in that company also its value increases. Bonds, this involves lending money to the government or other corporations. They do this to raise money for projects such as infrastructure or other internal projects. Mutual funds and ETFs, these are diversified group investments. Real estate, this is where you are investing in property. It can be in property appreciation or it can be in rental as a form of rental income. Then retirement accounts, the 401k and IRA, these are basically long-term tax benefits that help us to save money and access that money at a later time. It's important for us to understand taxes, insurance, and financial planning in the last section of our lesson. So, taxes, why are taxes important? Taxes are essential in any given country because they help fund essential services. Think of schools, think about roads, think about healthcare. Uh, Taxes enable the country and the government to fund these services. So understanding that some of the money that you earn, some of the your paycheck is entitled to deductions. This information will help you plan in real time on what you'll take home, the take home income, and therefore you start making important financial decisions, having in mind that your take home is this particular amount of money or this particular amount of money. So, financial planning also means protecting your money through insurance, such as health, auto insurance, life, or renters, so that you are prepared for any in unexpected uh, eventualities in life. The insurance essentials, like we mentioned, that financial planning connects today's habits to tomorrow's security. It's important for you to combine smart budgeting, consistent saving, and good insurance cover, as well as retirement planning. And this is not about perfection. It doesn't help you like to be perfect, but to give you a sense of direction and a sense of discipline when it comes to your finances. So financial planning involves components such as budgeting, um, saving and investing, insurance cover, retirement planning, as well as estate or legacy planning. As we come to the end of this module, there's a quiz for you as a task that you can execute, and just to enable you to help you apply what we have learned. And in this task, you'll create a monthly budget. So you do a record of your expenses, your income, your expenses, and simulate a checking account transaction, like how much money are you spending on this, and this. And so this will enable you to have a, a real overview of how a budget looks like. So, and at the end of the day, you'll make a conclusion. You'll look at it and um, realize like what surprised you, where did you spend more money, and what can you change. And so we mentioned early, budgeting is not cast on stone. You make some adjustment this month, and come next month you make some more adjustments, because as I've said, you keep adjusting your budget to suit your needs. So that is it about this. And just to summarize, you've learned how to manage your money, of course, with confidence. We've talked about budgeting. We've talked about banking, the basics of banking, how banks make money, how the roles of banks. We've talked about how you use credit wisely. We've talked about saving and investing, and as well as financial planning for long-term security. We've talked about insurance and the benefits of it. The takeaway is this one. If every dollar you earned had a job and worked a job, would you be a good boss? So that's the end of module one. We'll be seeing you in module two, and we shall look at more other factors. We shall look at other factors.